Ladies and gentlemen, welcome to the video presentation of the module on stages of venture capital financing. And this is Dr. S. Guruswamy, Professor and Head Department of Commerce, University of Madras. Now, for the next half an hour, I will take you to explaining to you as to what are the different stages of venture capital financing. A form of equity financing designed especially for funding high risk and high reward projects is known as venture capital. Venture capital plays an important role in financing high-tech projects, besides helping research and development projects to turn into commercial production. By financing technology, venture capital assists in fostering the growth and development of enterprises. In Western countries, for example, much of the capital is used for establishing technology and for expanding businesses. Venture capital fund activities generally include financing new and rapidly growing companies that are specially knowledge-based, sustainable, upscalable companies, purchase equity, quasi-equity securities, assisting in the development of new products or services, adding value to the company through active participation, taking higher risks with expectation of higher rewards, and having long-term orientation. Now, we will learn as to what exactly the venture capital companies mean. Venture capital refers to an equity or equity-related investment in a growth-oriented small and medium businesses to enable the investors to accomplish the corporate objectives in return for monetary shareholding in the business or the irrevocable right to acquire it. Venture capital is a typical private equity investment. Also, we can say venture capital is a popular method by which investors support entrepreneurial talent with finance and business skills to exploit market opportunities with a view to obtaining long-term capital gains. Venture capital involves the provision of high-risking capital, usually in the form of equity participation, to companies with high growth potential, besides providing some value addition in the form of management, advice, and contribution to overall strategy. Now, having learned as to what exactly the venture capital companies mean, we will go find out and learn what is the rationale behind these venture capital companies. The rationale for the venture capital arises on account of the fact that there is a high expectation for large gains for an entrepreneur, which acts as a motivation behind taking up risky investments that carry high return profile also. Venture capital investment is made with the objective of obtaining equity ownership in such enterprises initially and to take part in the growing prospects in the form of capital appreciation subsequently. Now, venture capital funds or venture capital companies do have certain characteristic features. Now, we will spend some time trying to learn as to what are the characteristic features of these venture capital companies. First and the foremost, new ventures. Typically, venture capital investment is generally made in new enterprises that use new technology to produce new products in expectation of high capital gains, sometimes spectacular gains too. The second important characteristic feature of venture capital company is that there is what is called continuous involvement, which means venture capitalists continuously involve themselves with the client's investments either by providing finance or managerial skills or providing any other support. Thirdly, there is what is called equity investment. An important characteristic feature of the venture capital companies is that there is what is known as equity infusion or equity investment that goes into the venture capital or the new companies. Venture capital is basically an equity financing method, the investment being made in relatively new companies when it is too early to go to the capital market in order to raise funds. In addition, financing also takes the form of loan finance or convertible debt to ensure the running yield on the portfolio of venture capitalists. The fourth important characteristic feature of venture capital companies is that every venture capital company works for an objective. The basic objective of a venture capitalist is to make capital gain on the equity investment at the time of exiting the venture and make a regular return of debt capital. It is a long term investment in growth oriented small medium firms. It is a long term capital which is injected to enable the business to grow at a rapid pace, mostly from the startup stage. Now, the fifth important characteristic feature of the venture capital company is that there is what is called hands-on approach. Venture capital institutions take active part in providing value-added services such as providing business skills, etc., to do the investee firms. They do not interfere in the management of the firms, nor do they acquire a majority or controlling stake in the investee firms. The rationale for the extension of hands-on management is that venture capital investments tend to be highly non-liquid in nature. The next important characteristic is that there is high risk and return which is expected by the venture capital companies. Venture capitalists typically finance high risk return ventures. Some of the ventures yield very high return. In order to compensate for the heavy risk related to the ventures, venture capitalists usually make huge capital gains at the time of exiting the new ventures, for example. Nature of firms. Another important characteristic feature of venture capital financing companies is that venture capitalists usually finance small and medium sized firms during the early stages of their development until they are established and are able to raise finance from the conventional industrial financial markets. And most of these firms are new, high technology oriented companies. Finally, the liquidity part. A typical characteristic feature of a venture capital financing company is that the liquidity of venture capital investment depends on the success or otherwise of the new venture or the product. Accordingly, there will be higher liquidity where the new ventures are highly successful. Now, having learned the characteristic features of venture capital financing firms, now we will move on to learn something on methods of valuation. So, how are these venture capital investments valued or evaluated? Let us know. The evaluation of venture capital investments are generally idea based and growth based, in contrast with the conventional investments which are asset based. Venture capitalists employ the following methods in order to evaluate their investments. 1. Conventional method. 2. First Chicago method. 3rd. Revenue multiplier method. In the case of conventional method of valuation, venture capitalists take into consideration the time at which the investee companies start the venture and the time at which such companies exit the investments. The exit may take place in the form of sale to public or third party and so on. The value of the venture for the purpose of investment involves the following computations. First, the annual revenue. The annual revenue at the time of liquidation of the investment is calculated as follows. For example, they consider the present annual revenue in the beginning compounded at an expected annual growth rate for a certain holding period. Then we also have expected earnings level as one of the methods. Then you also have future market valuation. Then you have what is called present value of venture capital, and finally the minimum percentage of ownership. All this forming part of the conventional method of evaluating the capital, the new venture capital financing firms. And now coming to the first Chicago method, this method gives relevance to the nature of the path between starting point and the exit point, and considers the entire earning stream. And we have certain steps which are required to be followed when you want to evaluate the worthiness or the value of the venture capital investment under the Chicago method. First one is the alternative scenarios. First and the foremost in the case of the Chicago method is that they consider the alternative scenarios, and they also take into consideration the present value of venture capital and the expected value of venture capital, and then the minimum percentage of ownership that's also calculated. And then the third method is the revenue multiplier method. Now, according to this method, revenue multiplier is used as a factor in order to estimate the value of the venture capital investments. And the venture capital investment is calculated by multiplying two important factors. One is the annual revenue of the firm and the expected or the estimated revenue multiplier. And this method is generally used in the case of early start or start of venture capital investments, where earnings based on after-tax profits may be low or negative sometimes in the early years. Now, having learned what are the different methods of evaluating the venture capital investments, now let us go find out or trace the history of the venture capital companies in the world. Venture capital financing originated in the US, especially after the Second World War, when investors came forward to invest their funds in new venture based on new technologies that promised very high returns, growth and prosperity. Such investments were popular with some of the wealthy American family firms such as the Rockefellers, Standard Oil, Andrew Carnegie, the Philippines, Bessemer Steel, and so on and so forth. The American Research and Development Corporation, ARDC, was established as the first venture capital organization in the year 1946. The object was the promotion of new technologies developed in institutions like the MIT. The other groups that subsequently formed venture capital funds include Draper, Gaither, Anderson, Davis, and so on and so forth. Now, having learned the origin and growth of venture capital funds, the world scenario, let us take a look at the venture capital financing, the growth of venture capital funds as regards India. Venture capital that originated in India, very late, is still in infancy stage. It was the BUD Committee, the Committee on Development of Small and Medium Entrepreneurs in the year 1972, which recommended the creation of venture capital. The committee targeted and urged the need for providing such capital to help new entrepreneurs and technologists in setting up new ventures. And some of the important venture capital funds that were set up in India were Risk Capital Foundation of the Industrial Finance Corporation of India, IFCI popularly called, the Seed Capital Scheme, which was launched by the IDBI then, and then we also had Venture Capital Scheme that was brought into existence by the ICICI. And then we also had the government fund. In fact, the government of India had a separate dedicated fund in order to support the new venture promotion. And we also had the TDICI, and so on and so forth. Now, having learned the growth of the venture capital companies in India, let us spend some time try to learn as to how the venture capital is closely related to some other similar such funds. Now, venture capital and development capital. Whereas venture capital is advanced for ventures using new technology or new innovation, in this type of financing, the venture capital company remains interested in the overall management of the project due to the high risk involved in the venture. Funds are made available throughout the project, commencing from commercial production to the successful marketing of products to ensure continuous revenue earnings, enhanced worth of the investment, and finally, making available a proper exit route for liquidating the investments. Development capital, interestingly, on the other hand, is generally granted in the form of loans for setting up industrial units and also for expansion and modernization. The lender here, interestingly, takes special care in ensuring the end use of the credit and requires prompt payment of interest and the repayment of the loan amount. And then we also have another interesting the relationship between the venture capital, the seed capital, and the risk capital. let us find out as to how these three types of capital are interrelated. There is no tangible, indeed, difference between venture capital, seed capital and risk capital. Both seed capital and risk capital are the components of the venture capital. Seed capital and risk capital are provided by all India financial institutions in the form of promoters' contribution to the project, with the emphasis on providing interest-free finance to encourage professionals to become promotees of industrial projects. Now, let us find out as to how venture capital is related to the National Equity Fund for Small Entrepreneurs. The National Equity Fund, administered by the Small Industrial Development Bank of India, popularly called the SIDBI, was established in the year 1987 with the object of providing seed capital assistance to small entrepreneurs in rural as well as urban areas with a population below 5 lakhs. And then, having learned how the venture capital is related to similar such funds, like for example the development capital, seed capital and so on, we will now move on to the most important part of the video presentation, namely we will try to learn as to what are the different stages involved in the venture capital financing. The first and the foremost is financing or providing seed capital. This providing seed capital is an early stage financing. Typically, this stage involves primarily research and development financing. The European Venture Capital Association defines seed capital as financing of the initial product development or the capital provided to an entrepreneur to provide the feasibility of a project and qualify as a startup capital. This stage involves serious risks indeed, as there is no guarantee for the success of the concept or the idea which was originated, for example, and the process pertaining to high technology or innovation. This stage requires constant infusion of funds in order to sustain the research and development work and establish the process to successful adaptation going into the commencement of commercial production and marketing. Venture financing constitutes financing of ideas developed by research and development wings of companies or at university centers. Chances of success in the case of high-tech projects are very, very limited or meager. The venture capital fund considers the following points in order to safeguard its own interest. First and the foremost, a venture capital company looks at the successful performance record, the entrepreneur's previous experience in similar products and technology and markets. So, this is the first and the foremost consideration which the venture capital companies take into consideration, for example, when it comes to the provision of seed capital. The second important consideration which goes into the the investment by the venture capital companies when it comes to the seed capital is that qualities of business management, technical innovation in the enterprise, realistic business plan with the clear future prospects for which seed capital is required. Now, coming to the next important stage of venture capital financing, which is startup financing. The European Venture Capital Association defines startup capital as the capital required to finance product development, initial marketing and the establishment of product facilities. This too falls under the category of early stage financing. The term startup refers to the stage where a new activity is launched. The activity may be one emanating from research and development stage or arising from the transfer of technology from overseas based business activities. Venture capital finance is provided to projects which have been selected for commercial production. The activity chosen for funding has the potential for fulfilling the advantage of the capital gain arising from the equity appreciation on the completion of such projects and marketing of its product ultimately. The venture capitalists on their part take into consideration such factors as the managerial ability, capacity, experience, competency, etc. of the entrepreneurs before making the investments of their funds in such new projects. The entrepreneur should furnish on its part certain information for the venture capital companies to decide about the desirability or the profitability or the worthiness of making an investment. What are those important details which the entrepreneur is expected to provide to the venture capital companies? One, brief history of the business or the project, a synoptic note on career history of entrepreneurs and key managers, description of product or service to be manufactured or rendered, description of the market for the product or the service with the existing or future state of competition, growth prospects in the share market, etc. Description of technical process involved and technology to be adopted in the manufacturing process, degree of technological obsolescence in technical process, financial history and forward projections of turnover profits, cash flow and borrowings over at least 2-year period, proposed deal structure for the funding being sought. In addition to this, venture capitalists have their own mechanism of appraising the venture capital, the new startups. What are the considerations which are kept in mind by the venture capital companies when it comes to the evaluation of the profitability or the desirability or otherwise of these new startups? First and the foremost is the track record. The track record of the promoter, entrepreneur, management skill staff resource is analyzed to evaluate the management performance record, ability and capacity of the entrepreneur to handle the proposed business plan successfully. The second important parameter which the venture capital companies consider while evaluating the worthiness is the performance assumptions. This is nothing but the technical performance assumptions about the product, about the process, about the service is very much taken into consideration. Besides, the technical strength of the proposed process or the service with reference to the product life cycle are also analyzed. Then the third important factor which is considered is the market potential. Market potential relating to the market size, growth and penetration are analyzed. In addition, evaluation of the existing market sizes, future growth of the market, ability to absorb the product or service, existing state of domestic competition and international competition is also carried out. The next important consideration is the cost structure. An analysis in order to evaluate the profitability of the projections on realistic grounds and cost assumptions and competitive price setting is undertaken as part of venture financing. Last but not the least, venture capitalists also consider the time schedule. So, within how many months or how many years the idea that has been originated can be put into the actual project in the form of the completion of the project by way of producing the product and so on. Therefore, the time schedule assumes an important part of the evaluation. Overall completion time is ascertained by evaluating the time schedule as given by the client for completion of the plan on a realistic basis and the experience gained by the venture capitalists, merchant bankers from other projects. The third important component of the stages of venture capital financing is the early stage financing. The European Venture Capital Association defines the early stage financing as the financing provided to companies that have completed development stage and require further funds in order to initiate commercial manufacturing and sales. They will not yet be generating profit, of course. This is the kind of financing required for completing the project. It is required immediately after the startup stage of a project. The enterprise may need further investments before the completion of the project. The need for additional funds arises when the project encounters cost and time overruns more particularly, or when the completed project starts making losses, thus necessitating the infusion of equity type of funding. This type of funding may also be required when the startup has been successful and the business is growing. The next important component of the venture capital financing is the follow-on financing. It's again defined by the European Venture Capital Association, and they say it is the follow-on financing or the second round financing is the provision of capital to a firm which has previously been in the receipt of external capital but whose financial needs have been subsequently expanded. Later stage in a project implies that the project has passed test of acceptability and has provided to be successful. Since project at this stage promises to be attractive in terms of earnings potential, it is considered to be the most attractive stage for venture capital financing. Financing at this point, interestingly, in the project is preferred by venture capitalists around the world, particularly in US and UK. The second type of financing which is being talked about as part and parcel of the various stages of venture capital financing is the expansion financing. Again, the European Venture Capital Association defines the term expansion financing as the finance which is provided to fund the expansion or the growth of a company which is breaking even or trading at a small profits. Expansion or development capital will be used in order to finance the increased production capacity, market or product development, or for the purpose of providing additional working capital. This is one of the later stage financing methods whereby finance is provided by the venture capitalist for adding production capacity once it has successfully gained a decent amount of market share and which faces increased demand for the product. Financing is also made available for acquisition or takeover. The next type of financing we have is replacement financing. Let us learn as to what exactly the term replacement financing means. Replacement financing is extended by the venture capitalist for the purpose of purchase of existing shares from an entrepreneur or other associates in order to reduce their holdings in the unlisted company, and this is happening by way of sale of shares, maybe by persons other than the entrepreneurs or their associates. The venture capitalist may buy ordinary shares from vendors and then convert them into preference shares bearing a fixed dividend coupon. Such shares may be converted back into ordinary shares if the company is listed, and thereafter the shares are sold, and thereby the venture capital companies make some decent amount of profit, sometimes windfall profits too. Another important type of financing method being talked about in the case of venture capital financing is turnaround financing. Now, this is the kind of financing which is provided by the venture capitalist in the event of an enterprise becoming unprofitable after the launch of commercial production. This is provided in the form of a relief package from the existing venture capital investors, and the enterprise is provided with the specialist skills to recover. This form of financing is popular in the US. Finance in this case is made available to a non-listed and non-profitable venture in the US. Finance is made available to a non-listed and non-profitable venture in need of equity funds to allow for a turnaround. The finance is also provided to sustain current operations of the enterprise. Now, another interesting part of or component of the venture capital financing is management buyout. MBO we call it. Of course, it is not management by objective, it is management buyouts. Again, the European Venture Capital Association defines the term management buyout as the acquisition of a company or the shares in that company from the existing owners by a team of existing management or employees. The vending shareholder may or may not have been actively involved in the running of the company. The acquiring company are presumed to be actively involved in the day-to-day running of the company and are making the acquisition with a view towards becoming active owner managers. Deals pertaining to the purchase of management holding of an enterprise are called buyout deals. Venture capital funds are made available in order to finance the buyout of management holding of the enterprise. Buyout financing originated in the US and is popular in the European venture capital industry also. There are some important characteristics which are part of the management buyouts, and these are: number one, it is a corporate finance in the form of equity in situations where the ability to obtain debt is very much constrained. Second, management buyouts are typically a financial arrangement which enables an investment in the form of management of an university firm. Thirdly, management buyouts make it possible for the surrender of a portion of the management's equity in return for finance from the venture capitalist. There are, of course, management buyouts do have certain difficulties or dangers. For example, the danger of management buyouts is that funds being so readily available, inadequate management teams may undertake them. One of the biggest problems facing these teams is the sudden realization that corporate-wide services once taken for granted are no longer available. Further, management buyouts often take place on the instigation of corporate finance teams of merchant bankers rather than the company management. Another interesting and equal, which is similar to or which is related to management buyouts, is management buy-ins. A management buy-in involves bringing in a management team comprising of outsiders who are more strangers to the company, as opposed to a buyout where they are part of the existing team. Again, the European Venture Capital Association defines management buy-in as the funds provided to enable a company's manager or group of managers from outside the company to buy in the company with the support of venture capital investors. There are certain elements which are considered essential for the purpose of making these buy-ins successful. Number one, a management team with a successful track record, preferably in the same industry domain as the company they are taking over, is an important requirement. The second important requirement is that an existing management which is willing to stay in place and work with the incoming management as a team. The third requirement is an investor who is able to judge the good management team and who is willing to take on the high risk associated with the buy-ins as compared to buyouts. The fourth important essential requirement for the buy-ins is a target company which is underperforming because of weak management. The risk involved in attempting a management buy-in are numerous, and this is likely to be a casualty when it comes to the buy-in. And thanks for watching this video presentation, and I wish you good luck.